Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker, with our guest, Evan Rothschild. Before we get started, we have a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, and that this is for educational purposes only, welcome, Evan. It's the first time I think we've really talked, and I saw your presentation at the Options Tribe, I don't know, a month or so ago, and I really liked it and thought that people at Capital Discussions could benefit by having a presentation on risk and what the markets can really do, kind of open some eyes. So welcome, and maybe a few words about yourself, and then we can get going.
Sure. No, thanks for that, Tom. Yeah, I guess, I started out as a finance major in college and was an equity analyst in the late 90s. I worked at an investment bank and at several mutual funds, covering all kinds of stocks, mostly consumer, but did energy, I did telecommunications, just a number of different stocks. And it was a really good education in understanding not only companies and markets, but what drives investors to make buy and sell decisions. And then for the last 7 years, I've been focused on trading, and for the last 4, primarily trading index futures and options. Can you see the screen okay?
Yeah, looks great.
Okay, terrific. Here's, I guess, another disclaimer slide. Basically, my rule is if someone gives me an idea and it works, I give them credit for the gain. If it doesn't work, I take the blame for the loss. I kind of feel like if we all have that attitude as traders, it'll make us more collaborative and more successful, so hopefully everybody shares that thought. Here's an old quote from Ed Sequoia, a highly successful trader featured in the Market Wizard series by Jack Schwager, that there are old traders and there are bold traders, but there are very few old, bold traders. In meeting options income traders over the years, it is obvious that almost every one of them believes that they are conservative with their portfolios. Most theta traders define conservative to mean using strategies that make money 70 to 80% of the time or more and have historically acceptable monthly loss levels. They care much more about what has gone wrong versus what can go wrong. And so they bank on back testing and stock market history entirely to protect their accounts. To me, that is being too bold. I guess I'm not wired the same way as other option traders because my main focus is not on what has gone wrong historically, but what can go wrong, period. It's not that I'm a pessimist. I actually maintain a reasonably optimistic outlook. But I can only invest knowing that my portfolio can survive anything that could possibly happen tonight and for the next 20 years. My focus is always on risk. And so while other traders seem to prioritize new indicators or strategies or setups or patterns or whatever, I've always been driven to master risk-reward, position sizing, hidden risk, T+0 risk, portfolio risk, just everything on the risk side. And after watching other option presentations this year, it was clear that I had a very different view of acceptable risk than many other traders. So I put together this presentation as an alternative viewpoint of what risks are appropriate and which ones I think absolutely should be avoided. Here are some of the survey results from the poll you may have seen last week. Thanks so much to all of you that actually responded. That was very helpful. What we were trying to find out was the maximum percentage of capital that traders say they can accept losing overnight if something went crazy in the markets. As you can see, the average was 13%, with the median and mode at 10%. So most traders say they would not be able to accept what I would consider a very large max loss. While one interesting trader says he or she can take 100% loss in their trading account, a number said they couldn't handle more than 1% decline overnight. I want you to think about your number, and at the end of the presentation, I want you to perfectly understand if there is a gap between what you want to risk in your accounts and what percentage you are actually risking. because it is not acceptable as traders to want a 13% maximum loss and see anything greater than 13%. Dr. Dan Harvey, the father of the WEIRDOR, apparently has a saying you might have heard that the markets can do whatever the heck it wants whenever the heck it wants. And I'm sure we all agree that this is true. But what I'm not sure we appreciate is how large whatever the heck it wants whenever the heck it wants really means. What you are looking at is a headline from the October 1987 crash when the markets fell in excess of 22%. Traders I've spoken to who were around then tell me it was much more incredible to deal with versus the flash crash or the 2008 financial crisis or the tech bubble or anything else in the markets for the last 30 years. To give you an idea, if that happened today, the RUT would fall more than 260 points and the SPX would fall over 440 points. And in looking at this headline, what I want you to realize is there is nothing necessarily that prevents an extraordinary move in the market, like the 1987 crash, from happening again at levels equal to or exceeding 22.6%. And if we aren't prepared for a move like that, our accounts could blow up. I'm reasonably sure you all understand the math of losing money. A loss of 10% requires a gain of 11% to get even. A loss of 20% takes a gain of 25% to get even. What I want you to focus on are the big losses, 50%, 80%, 90%, and how damaging they can be. 100% being the worst because we have to stop trading. Blow-ups are clearly the worst thing to experience as a trader, and you only need to blow up once to ruin your portfolio. So my question is, why would you ever put yourself in a position where your account could blow up? And are you doing that now? In 2004, Nassim Taleb wrote a book titled Fooled by Randomness, which has influenced my thinking of risk more than any other text. In this book, Taleb talks specifically about premium sellers, which are the same as the theta or income trades that many of us here utilize. Taleb's problem with premium sellers is that they can make money month after month after month, which makes them overconfident this success will continue. This overconfidence leads to taking too much account risk. And when premium sellers carry too much size, Taleb says, it's like playing Russian roulette with your portfolio. For those that don't know, Russian roulette is a really stupid activity where the bettor places a single bullet into a revolver, spins the cylinder, places the muzzle against their head, and pulls the trigger. Normally it's played with a 6-shooter, so you'll have an 83% chance of winning something like $10,000 and a 17% chance of dying. It's really stupid, so please don't do that. But Taleb said that instead of a 6-chamber gun, the premium sellers with too much risk might essentially be pointing a 100-chamber gun or a 500-chamber gun at their portfolios. And while they're collecting that same $10,000 or more month after month, it is done so by shooting the gun at their accounts that blows them up should the bullet line up. So the question is, how low do the odds have to be, or how many chambers in the gun is an appropriate level to play Russian roulette with our portfolios? I would argue it's never worth playing. In order to understand how to not blow up our accounts, I thought it would make sense to first do the opposite. Let's look at the easiest way to blow up our accounts. And I think we would all agree that the easiest way to blow up is to sell naked options on really volatile stocks like tech and biotech. I hope that's not too controversial. So here's Celadon. It's a biotech that got bad news a few months ago on its main drug. You know, imagine that you were selling the $10 puts after earnings for 50 cents, figuring that you had plenty of time to cover and there was no news coming out. You wanted to make $5,000 and ended up losing $75,000 overnight. Not a fun experience. Another example, Google from this past earnings report. The stock was trading around $500 a few weeks before earnings. You wanted to make that same $5,000, figuring Google wasn't going to move more than 20%, and so you sell 100 calls at the 600 strike for 50 cents each, and you can see them actually fall down to 10 cents. Later, as the stock moved up, you figured, well, why not wait for earnings since Google just moved up 20% and the news can't be that good? Then the stock gap's way higher and the calls gap to $80 overnight, and your $5,000 potential gain becomes an $80,000 loss. All right, so that wasn't so controversial, right? I mean, selling naked options on volatile names, I'm pretty sure nobody here really wants to do that. So how about we take it a step safer, selling options naked in any non-volatile name? What's wrong with that? Well, you still have all the same risks. It might be less likely, but it shows up in less option premium as well. Here's HCC Insurance, a stock that was basically trading between 56 and 59 for months. And it's an insurance company, so it isn't supposed to be volatile or react wildly. Except in June, it got bought out, and the stock gapped to $77 or more than 40% overnight. If you were selling 200 of the $60 calls for a quarter to try to make $5,000 this month, you lost $335,000 overnight. It's hard to get back to even when your losses can be 68 times the size of your wins. Another example is the car manufacturer Volkswagen back in 2008. Porsche was intent on buying Volkswagen and then, I guess, publicly backed away during the financial crisis. Tons of hedge funds shorted Volkswagen post the deal falling through, and then all of a sudden Porsche changes their mind and wanted to acquire Volkswagen again. This created the greatest short squeeze in modern history, causing an €800 move in 2 days. Now, if you think it was tough to buy shares, imagine trying to cover your naked calls at the $400 strike in a less liquid market. You would have been ruined. And again, it's a car company, so not a historically volatile name. Okay, so maybe now you might agree that selling naked options in individual stocks carries a lot of risk. However, why not sell options on an index like the S&P 500 or the Russell 2000? There isn't takeover risk, there aren't earnings announcements or guidance changes or drug approvals to worry about. You back-tested how far markets have moved in the last 20 years or longer. How can you get hurt? Well, here's where the idea of black swans come into play. A black swan in nature was initially assumed to not exist because no one in Europe or the Americas had ever seen one. Then explorers went down to Australia and found them to be quite plentiful. The point is, just because something has not been observed, that does not prove it cannot exist. In the markets, black swans refer to extraordinarily large and unexpected events that have incalculable, that's easy for me to say, really hard to calculate consequences that can't be determined just from looking at history. And so we have to be prepared for the unexpected. A crazy example of a black swan would be if the aliens come to Earth tomorrow. Don't worry, I don't actually think the aliens are coming tomorrow. But thinking of it as a trader, would aliens be a bullish event or a bearish event? I have no idea. It could be bearish if the aliens are coming to take our water and natural resources and leave us in a barren existence. It would be bullish if aliens are coming because they're big consumers and love Starbucks coffee and McDonald's hamburgers and Disney movies and offer the equivalent of 100 billion new customers to serve. The point is, I don't know if the aliens are coming, and if they do come to Earth, I don't know if it's bullish or bearish, and I don't know how to calculate what it would do to the markets. But I do know that I need to set up my portfolio so that if something as crazy as the aliens landing tomorrow would not blow up my account. So here's an example of the last big black swan event, the terrorists striking America on September 11th, 2001. Suppose you were short the $44 puts on the IWM on September 10th after seeing a doji candle in an oversold market, thinking it's a high percentage way to make money. And then the markets gap down 7% overnight and keep falling another 10% all the way into expiration. An attempt for a small gain would have likely ended in a much greater than expected loss. Another point on this, these major once-in-a-century market events seem to happen about every 5 to 10 years on average. Sometimes it takes more, sometimes it takes less, but about every 5 to 10 years. And now we've gone about 5.5 years since the flash crash in 2010. I wouldn't even count what happened in late August, which was reasonably mild by historical market moves. And so my question is it wise to bank on a normal market for an extended period of time? I would argue that it's not. So because the future is unknowable, and because we as traders must be prepared for anything, we have to know our worst-case scenario. It's not enough to know where we will close the trade, or where we will place a stop, or what is most likely to happen. Many traders resist looking at the worst-case scenario and preparing for it. And they do this by making a number of excuses for too much risk. Let's look at those excuses. Excuse number one, it's never happened before. The modern stock market has been around for about 115 years. Do we really think that all the permutations and possibilities for the markets occurred during that single 115-year era? The Earth is something like 4.5 billion years old. 115 years is really just nothing from an historical standpoint. Also, every historic worst-case scenario within that 115-year period was by definition worse than anything that preceded it. We can test strategies historically as a guide for profits in normal times, but for risk management, we can only depend on worst-case scenarios to save us from disaster. An example from the currency market this past January in the Swiss franc. Currency, if you don't know, is by far the most liquid market in the world. That's because you can't sell the euro without buying dollars or the yen or something else. You can't go to cash because cash is currency. Switzerland is a relatively stable country that one day decided to no longer peg its currency to the euro, which then saw its Swiss franc gap up 20%. Despite being the most liquid market in the world, shorts did not have an opportunity to cover. The result was a successful brokerage house in Europe named Alpari, one that was large enough to sponsor an English Premier League team, was blown up overnight from extending too much leverage to clients. Many hedge funds and traders also blew up being short the Swiss franc. And if you had money with Alpari, a brokerage house that lends too much to their clients, then you lost a ton of principal as well. The point is, again, just because something hasn't happened doesn't mean it can't happen. All right, excuse number 2 for too much risk. Statistically, I can't get hurt. What you're looking at is a bell curve that we all recognize from stats class, right? You might remember that one standard deviation is about 68% of all results, where all results occur, 95% for 2 standard deviations, and 99.7% for 3 standard deviations. And it's so tempting to take that math to the markets and make high probability trades 3 standard deviations out that make a little money each month with tremendous downside that you never expect to worry about. Here's the problem with that. The market is not the same as picking a card from a deck of 52 or rolling any dice. It's driven by people. And when people get scared, they can sell at any level. When people get greedy, that is just FOMO, or fear of missing out, and they can buy at any level. Emotion trumps thought. And with the increase in computer trading, things are not any better. For one, these computers are programmed by humans. And 2, the computers are not value buyers. This isn't Warren Buffett's computer deciding in nanoseconds that Apple has gotten too cheap. Instead, the computers are trend traders, going short into down markets and long into uptrends, exacerbating those moves. As a result, the market does not follow the normal distribution of a bell curve. What you're looking at is 10 years of S&P daily price data compared to a computer simulation of a bell curve. And what you might notice at first is how high in the middle these blue lines are at the center. These excess non-volatile days lull traders into a sense of security that the markets can be predictable and tame. Now what I want you to pay attention to is out on the edges. Far outside the 3% range, which represents about 3 standard deviations. This phenomenon is called having fat tails, and reflects having much more volatile movement in the markets than expected, according to bell curve statistics. I'm not sure if the audience is familiar with Myron Scholes and Robert Merton. They were University of Chicago PhDs that developed the Black-Scholes formula, which, if you don't know, is the accounting method for how option prices are calculated. These are brilliant guys. In 1995, they started an investment firm partially using Black-Scholes, where they stated that statistically, their investments could not get hurt. In 1995, they were up 21% and made a few $1 million, and then attracted a bunch of assets. In 1996, they were up 43%, brought in more assets, and made $10 million more each. In 1997, they were up another 41%, made hundreds of millions of dollars, and won the Nobel Prize in Finance for their Black-Scholes model. I didn't tell you the name of the fund. It was called Long-Term Capital Management. And in 1998, they lost $4 billion of investors' money and their own in the Russian debt crisis by both selling naked options and using too much leverage. Again, they thought statistically they could not get hurt. So unless you were smarter in statistics than the creators of the Black-Scholes formula, I'd say it's hard to argue that statistics will save your portfolio from too much risk. All right, excuse number 3 for too much risk is diversification. Excuse me. There's a thought that markets act independent of each other, so if we take risks in different asset classes, even unlimited risks, that diversification will save the day. I copied this slide from a naked option seller that made a presentation earlier this year. Their point was that while the SPX was highly correlated to the Russell 2000 and the NASDAQ and even Apple, but that by diversifying into oil, bonds, gold, and the euro, this would provide a well-rounded portfolio safe from problems. And you can see here, where the correlations are, much closer to zero. The fallacy with depending on diversification is that in extreme times, investors only want safer investments and cash. That means that all asset classes become highly correlated no matter what occurs normally. Well, here's the SPX during a difficult trading period from June 2008 through mid-November. During this period, the market fell 46% from top to bottom. Let's see how the non-correlated asset classes did. Remember, if they are truly uncorrelated, there should be no major move in almost any of them, just because the stock market was almost cut in half. Well, oil saw a major move down of 60%, falling even more than the stock market. No diversification there. And bonds act opposite of stocks in direction, but again, this trader was selling naked options, so banking on a muted move. Instead, the major move, 20% is a major move for bonds in what was a flight to quality. Gold fell 30% in 2008, again falling as part of a flight to safety and out of anything that would be considered a risky asset. Finally, here's the euro, down over 20% as the world looked to own dollars over anything else. The message to me is clear. Diversification will not save you in troubled times with unlimited risk positions. Okay, excuse number 4. Using undefined risk is okay because my position sizing is small. This comes from selling calls or puts as a method of either hedging or trying to goose returns by 1 to 2% a month. Usually traders doing this think they're being conservative because they aren't looking for large monthly returns. The problem is you're still playing Russian roulette. You're just reducing the odds of seeing the bullet that particular day. Here's a quick look at how the odds work. Let's say you have a portfolio that will not blow up 99.99% of the time, or it requires a 1 in 10,000 chance of a disaster happening. You might feel pretty safe taking that risk. However, 99.99% chance of success is still a 0.01% chance of portfolio death. And 0.01%, while small, is most decidedly not 0%. Well, if we take that 0.01% and multiply it by 365 days and then by 20 years, we get an almost 52% chance of your portfolio blowing up sometime in the next 2 decades. In other words, it is more likely than not that you will cause major damage to your account at some point in your trading career just by taking a 0.01% chance every day. Even if you reduce size so that only a 1 in 100,000 mega disaster blows you up, you are still ruined at least 7% of your time. That's at the bottom there. We need the odds of blowing up to always be 0%. All right, final excuse for too much risk. The idea of using stop losses on options. It seems like it could work if you stick to really liquid markets. For this excuse, I want you to think about how often you might complain about getting orders filled at reasonable prices. Now let's think about what was the worst trading day of your career so far and multiply it by 10. All of your short deltas go to 100 and the bid-ask spreads widen to crazy levels. And if you want a fill, you're going to pay through the nose for it. Do stop losses help in this environment? Maybe, but not enough to depend on, and certainly not enough to justify taking too much risk. One other thought on black swans. It doesn't just have to happen to the market. Suppose you personally get hurt or sick. Can your portfolio survive weeks without you? Will you finally get healthy only to discover that your account died while you were in the hospital. It's something that we actually need to account for. All right, after hearing all that can go wrong, I think it's time for some solutions so that we can trade with confidence even if the markets deliver us a worst-case scenario. Solution number one, no naked option strategies. I hope by now I've given you enough fear for the potential of incredibly large moves in the markets. That potential needs to be respected with protection for your account. That means verticals instead of naked options. And if the pricing of verticals isn't good enough for a trade to make sense, then that means passing on those trades until you find ones that work. One bad naked option trade can ruin an account and a trading career. Solution number two, the 25% max loss. Options' greatest feature is not leverage, and it's not theta, and it's not vega, or any of the Greeks. The best part of trading options is the ability to limit our losses despite whatever the market might throw at us. So if we limit our capital used in trades to 25%, the most we can lose is 25%, even if the market goes to zero or the market goes to $1 billion. If this 25% number seems low to you, remember that our traders in our survey said that the most they could handle losing overnight was 13% on average and 10% as a median. Well, if you want to limit maximum losses to 13%, you would have to limit capital usage to 13% as well. There's no free lunch to using more capital without taking more risk. Looking at this on an option trade like John Locke's M3, it means we don't just have to worry about the T+0 line for controlling risk. It means we have to respect the full expiration graph. The good news is that line is the easiest to control, as we just don't put any more money in the trade than 25% of our account. And so if we have $50,000 used in a trade or a combination of trades, we need to have at least $200,000 in that account. That's the only way to guarantee that you don't lose more than 25% overnight. The pushback I get most often on the 25% solution is complaints about how it will reduce profits. Well, let's imagine together your situation if you do experience a large blow-up in your account because you ignored overall account risk. Number one, a lot of your money will be gone. And number two, you will likely give up on trading. Now, I imagine most of us join capital discussions because we love trading and secondarily because we also like money. Losing both overnight to a disaster would be awful. But the difference between being down 25% and being down 80% is the difference between a really, really bad day and being financially ruined. Now, don't get me wrong, if I would be in a really foul mood if I lost 25% in a day. But I would be able to keep trading, and I'd expect to eventually make my losses back. Down 80%, especially late in a career, is just a nightmare that cannot be recovered from. After I finished a presentation in August on this subject, I got a lot of questions about using out-of-the-money put options as protection or a hedge so that traders might continue to use 50, 70, or 100% of their capital each month and make much better returns. So I figured let's ask the traders here what trades they're using to see if any utilize a strategy, this as a strategy, the out-of-the-money puts, and analyze it from a risk perspective. It turns out that the third most popular trade among participants in our survey was the WEIRDOR'S/Jeeps trade, which uses those out-of-the-money puts. All right, so what about the WEIRDOR? If you're unfamiliar with the WEIRDOR trade, I apologize, but I'm not going to go through it right now. There are plenty of videos in the archives at Capital Discussions that can explain it much better than I. But I'm sure this audience is sophisticated enough to follow a P&L chart of a trade, even if they haven't seen it before. Anyway, here's the basic risk graph of the trade, of the WEIRDOR. At its starting point, which is basically a number of vertical spreads at different strikes and ratios depending on the relation to where the market is currently trading. In addition, the WEIRDOR adds an out-of-the-money put option right down here, well below the market as part of its risk management. By simply adding this out-of-the-money put, it changes downside risk, so a future 22.6% decline in the markets might even make money. And at worst, it seems to limit risk to 43% or less. So let's go through this trade in a way someone selling you on the limited risks of the WEIRDOR might, to try and make you feel safe. Most of the time in theta trades, when you increase volatility, it is a bad thing for your P&L. But with trades using out-of-the-money puts, the model shows it to have the opposite effect. You can see it here as I increased volatility by 15%, and the T plus 0 line pushes from 43% to 34%. All right, so I'll go back. Here's the original. You can see volatility is at 0%, and the dot's at 72,000, 43%. And we go back, volatility is up to 15%. Risk has fallen to 56,000 or 34%. So we've fallen from 43 to 34. That's because the volatility affects the value of that out-of-the-money put more so than any other part of the trade, lessening the loss. On top of that is that in insane down markets like the flash crash, the out-of-the-money put's value can grow out of whack thanks to tremendous vega beyond what is even calculated by OptionView or whatever stats package you are using. If you go back and model strategies like the WEIRDOR in May 2010, you might find the dot for where your position P&L stands well above the T plus 0 line. Here risk seems to peak out around 17% of capital. This probably makes the trader backtesting the WEIRDOR feel great on risk control. It's been argued, therefore, that the WEIRDOR and other strategies that use out-of-the-money puts are better mousetraps. They win something like 80% of the time, losses are normally small and manageable, and the big loss is possibly only 17% of capital used. Is this the kind of strategy where you can put 80 or 90 or even 100% of your capital into, get great returns, and feel comfortable because a black swan can't hurt your portfolio by more than 17% or so? Of course, everyone would be intrigued by those stats, so here was my process to test it. First, on Tom's suggestion, I watched a presentation on crisis management by Mark Sebastian. Mark's 2 slides on trading in a crisis were so good, I decided to just steal them openly rather than pretend they were mine. The basic idea, though, is that in times of great stress, liquidity in financial markets goes away. So even though OptionView or your broker's software might be telling you that your portfolio is holding up well, your ability to trade out of your position is severely limited by a market that has no interest in buying your risk. After all, who wants to own option spreads at prices that peak 15% higher than the underlying index? Second, you'll have no chance of selling your individual spread parts of the trade, which opens up your portfolio to all kinds of risk. That's because all option spreads, let alone multi-leg orders, are just being ignored. If you aren't willing to put a market order of individual puts or calls in, you just aren't getting filled on those crazy days. And here's a link to Mark's presentation if you'd like to watch that as well. All right, so let's think about the WEIRDOR again in this environment. A crisis hits, and you were looking at this dot on your portfolio and think, if I can get out on this crazy day at this limited loss, I'm going to be thrilled. Great. Now what do? What do you sell first? If you sell the put, which is juiced up by volatility in the market craters, you've lost your protection. If you keep the put and volatility falls, you risk falling further down on your P&L. You could try selling parts of the Jeep, but again, no one is really interested in purchasing spreads. So you have to sell individual way in the money puts, not as part of a spread, while they are trading at very wide bid-ask levels. This WEIRDOR is a trade that requires patience and skill to get out of normally with all those strikes and spreads. So just imagine after a black swan. So instead of 17% risk or less, maybe it's closer to 51% just on execution, or about 3 times worse. Maybe you could do better if you were patient getting out. Maybe being patient leads to more problems if this happened a few weeks into the trade. Now, 51% is still not that bad compared to 100% everywhere else if that actually represents max risk. But something about even severely taking a haircut based on execution still wasn't sitting right with me. So I went back to the black swan definition. Again, enormous consequences that are impossible to calculate. And then I thought of the markets on September 11th, 2001, which was the last significant black swan event. That's when the light bulb went on for me. Were any of you trading on Tuesday, September 11th, 2001? Do you remember what the market did on Wednesday, September 12th? It was closed, and then stayed closed on Thursday, September 13th, and closed again on Friday, September 14th, before finally reopening on Monday, September 17th. So that made me think, what if on the next black swan event, a consequence is not only a 15% fall in the markets, but also the market is closed past your expiration date? Options traders are not considered the most important players in the investment ecosystem. Most all decisions are made for the benefit of the equity owners. Do you think the heads of the exchanges will give you time to adjust your now expired positions? I don't think they would. They would probably decide that wherever the RUT or the SPX opens is where those options officially expired. And so that means that instead of risk being only 17% or 34% or 43% or 51% of capital, then we are really risking up to 100% of any capital invested, just like with every other option strategy. And so if you have 80, 90, or 100% of your portfolio in the WEIRDOR, it's the same as having too much capital in the M3 or the bearish butterfly or any combination of option strategies, in that it could all go away tomorrow. Now, is this scenario unlikely? Yes, but so are all the other 1 in 10,000 possibilities. Is it any less likely than a down 22.6% day? I would say no. Remember, you only have to blow up your account once. Either way, the point is if you invest 50% or more of your money in a strategy like the WEIRDOR, you can absolutely lose all the capital invested despite what OptionView or salespeople might tell you. And that gets back to the original solution number 2. You have to keep invested capital small to manage risks, and in my opinion, to less than 25% of your account. One other question I get asked a bunch is if there's an opportunity to go long volatility and really cash in should a black swan event occur. Usually this was followed by asking if VIX calls or some of the volatility ETFs were appropriate. The problem with VIX calls is that they're European style. That means you do not have the right to exercise them prior to expiration, which means in the event of a black swan, not on expiration day, that not only will the VIX calls have wide spreads, but also the bids can be significantly lower than parity. Here's an illustration from the August 24th strange move in the market we just had last month. If you were along the $14 VIX calls, this was the day you'd been waiting for. You know, that VIX ran all the way up to 50 that day, but it closed around 40. Unfortunately, your $14 VIX calls are only bidding $11 instead of the $26 you expected minimum. That $15 gap between the $26 parity value you expected and the $11 bid is all due to the European-style nature of the calls, because you have no rights to exercise and the market doesn't want to offer you full value. By the way, the SPX and RUT index options are also European-style, so you could find yourself with the same problem of pricing not being what you need to get paid on a low probability event. As for the volatility ETFs, here's the UVXY. If there's a product that's destroyed more value over the last few years, I can't think of it. Because of a concept called contango, which is extraordinarily difficult to explain and not important for any other type of investing, so I won't go into detail, these funds are down more than 99% from where they opened and have gone down every year and almost every month. And because of this same contango, if there's some crazy event, you would not receive an asymmetric payoff where you can buy for $27 now, and even if it goes to a penny later, it would go back to $400,000 after a black swan, making everything well. So no, I don't think there's an opportunity to make an absurd amount of money going long these funds waiting for low probability events. You would have to time them perfectly, which is nearly impossible, or you're going to lose money. You can see here that even after the larger than normal move in late August, that we still aren't 50% of where the UVXY was to start the year. However, I do think there could be an opportunity to make money should a black swan occur by shorting these funds. If these awful products are up on wild news and likely trading at a premium, in my opinion, that would be the opportunity. There are never any guarantees, so you always do so with protection, either by buying a call while shorting or buying puts. you're always going to want to have limited liability in your portfolio. But after any of these stupid volatility ETFs make a giant move higher, I'm sure there's great risk reward in betting on them to start moving lower again. Here's my final thought. You can always be perfect in risk management. Your edge may go through periods of underperformance, your ability to execute trades may come and go, but it is easy to master risk control just by limiting the percent of capital used. And because it is so easy, there's no excuse for not being great at it. I'm going to thank you for your time today, and I'm happy to discuss or answer any questions if there are any.
Well, thanks, Evan. Nice presentation. I think we had a couple of questions.
Okay.
Jean-Claude says, when you're talking about shorting naked puts, he says it's simply like owning the stock, and I would guess the risk is that you're shorting too many puts. Some people use like cash secured puts, but I think many people who trade naked options don't do it that way, and they're taking too much.
If you're using cash secured puts in a way where you're using it as if you were going to invest in the company, and so you would buy 100 shares of a certain company, and instead of doing that, you're going to sell one put option, I guess. That's fine. That's fine because at least you have the cash there, and you set aside. And ideally, you have it at a position sizing where it doesn't represent too large a position of your account. Like normally with investing, you're not going to want to own, certainly more than 10% in any particular stock, and most of the time it's not more than 2 to 5%. So long as that's the case on a cash secured puts, I think that's fine.
Just to answer John's question, he says, is the recording available or the slides? I'll put the recording in the members area on the capital discussions, and Evan, if you don't mind sending me the slides, I'll post those with the recording.
Sure, that's fine.
Okay, and then Andrew says buy XIV on volatility spikes. I guess you could do that.
You could do it on volatility spikes. I mean, it's an awful product, right? And so if you're just sort of looking for opportunities when, like we had last month, where, things got much more volatile than normal, and if you shorted those products, at higher levels, as long as you're doing it with limited liability, I have no problem because eventually these products are going to go back down. That's just the nature of how the contango works. And, as long as you're not putting yourself in a situation where you could get black swan, where you put them on after a crazy event and then even a crazier event happens. As long as you're not doing anything like that, I think that's fine. My thought is after a big crazy event, you put on something similar. You either short them with calls or you buy puts, limited liability, and you just take advantage of the fact that they're poorly put together.
Andy asks, Evan, if you want to sell a straddle, how would you position size the position to manage the risk?
If I were to sell a straddle, I guess to start off, I wouldn't sell a straddle. I mean, what I would do is I would sell them as two verticals. To me, selling a straddle is essentially asking for trouble. You have to be wrong once to have it go really, really wrong. And so if you were to, let's say you sold a straddle on the S&P, and then the next day the markets fell by 50%. My guess is even if you did one contract on each side, my guess is that would be very, very painful for you. And so, to me, you're always going to want to have protection, and so you'd always want to have a vertical on that side. And so I'd be using the buying of both a call and a put at higher and lower levels as a way of providing that protection and making it reasonable. And if it doesn't make sense mathematically to do it with verticals, in my opinion, it's not worth putting on that trade. If it's only worth doing with unlimited risk, then it's not worth doing.
And Andrew says XIV is the reverse of the VIX. So I guess if you could buy XIV on a volatility spike due to that mean reversion.
Yeah, I guess you could. You know, I think they're all. I think they all sort of work that same way, where you know, with the exception of the futures, the VX futures, they all sort of work the same way, where they have this, you know, as if they just sort of go up, if the main product goes up and down the same amount every day, then the derivative products lose money. You know, it's just like doing the triple Qs or the negative triple Qs. If you'll notice, if the market's just sort of sideways, those products are always going to be down, and that's because they sort of they have to rebuy themselves and at different levels, and it's just sort of the way the math works. It's just like when you lose 10%, you have to make up 11% to get to even. The way they're organized, I know it's sort of complicated, but the way they're set up, that they don't do that. And so if the market goes down 10% one day and up 11% the next day, it doesn't get back to even. It actually would lose money. And I'm pretty sure the XIV is a product just like that.
Yeah. John Bailey says he was successful in owning long UVXY calls, which increased 200 times 3 weeks ago. He said, I may not have been able to sell them out on Monday, but he had no intention to. Eventually, he sold them in tranches over that week, successfully hedging his losses. So that was a good hedge on the rest of his portfolio.
Yeah, I'm happy that he was able to make that work. The issue with those products is that you've got to be perfect on your timing, right? If you're not perfect on your timing, they're so bad that, like I showed a chart that of I think it was the UVXY, where if you bought them at the beginning of the year, and then the markets really didn't do anything for the first 6-8 months. And we're sort of flat, and then we had this extreme spike. Well, if you had bought at the beginning of the year, you know, the value would be half of what you had originally, and that's only after the spike higher. And so because of that contango, because the products are so bad, it's really hard to time it right. Now, if you're excellent at timing and you know, think you can find advantageous periods to buy this product, you know, I guess that's good for you. I would say there's probably better opportunities in other products that just don't go down as a normal part of business. And so that's why I recommend trying other ways of playing either other products or only playing these products to go down after they've spiked higher.
And John adds to that, he says, rolling them 2 weeks out all the time when VIX is 15 to 20, holding UVXY stock bought when cheap or assigned puts, selling calls constantly to finance UVXY stock drag.
Yeah, I mean, if you've got a system there where you're you know, selling stuff, you know, it sounds like you're selling calls and you're buying the product. You know, it's hard to see what exactly your risk looks like without a risk graph. You know, if you've got a system there where you're not, it's not losing money at month after month after month waiting for a big spike, and then if the big spike occurs, you're not getting hammered. You know, that's great. I have found that I found them to be a tough product to deal with on anything other than expecting them to go back down. But you know, certainly I don't have a monopoly on all the ways that can be made money out there.
And Bob Alexander has a good question. He says, what's the takeaway for this presentation?
I'm hoping that the takeaway from this presentation is a respect for what can happen in the markets, and that respect will be answered with keeping risks low through your portfolio, so that If you do trades like the theta trades that most of the traders here do, the M3, the bearish butterfly, the WEIRDOR trade, what have you, that you shouldn't be putting more than 25% of your account in at any one time if you don't want to lose more than 25% overnight. If you're comfortable losing 40% and you accept that at some point in the next 20 years you'll have a down 40% day and you're okay with that, that's fine. You can go up to 40%. But the idea of putting, 60, 80, 100% of your account into trades at any particular month, thinking that you're going to be okay, I'm looking at that and I'm seeing someone that is more likely than not to blow up in the next 20 years if they keep up doing that as a trader.
David says, on a severe down day, would you expect any difference in execution between an electronic RUT versus open outcry SPX index?
Would I expect any difference in execution between the SPX and the RUT? Historically, the SPX has a lot more open interest, and so there's just going to be a lot more liquidity there, period. But, it really depends on the strikes that you're talking about, right? I mean, the at-the-money strikes for the RUT are going to be much better than the way out of the money or the way in the money strikes for the SPX. So I would think about it that way. I would expect that it's going to be difficult on these crazy days, just like it was, a few weeks ago on August 24th. The first 15 minutes, chances are when you logged in, you were getting late prices. You weren't getting accurate prices. If you were putting in trades, you were having difficulty having them executed. It'd be that kind of environment, but except for 15 minutes, it could be all day. I mean, that's what October 87 was like. It was all day of falling in pressure and problems.
Let's see, Joe DeCaro says, in your studies of Black-Scholes events, do you have any idea of the average recovery time to come back 50% of the loss or any other number you know?
Yeah, I mean, it can be interesting to try to Monte Carlo these kind of events, or to try to see, okay, in 87, the markets, fell off or, recovered and then fell off, I guess, through December, and then by a year later, they had about, a year and a half later, they had about come back to where they were before. The problem is there's no rules, right? There's no rule out there that says if there's a black swan hits and the markets are down 50% overnight, that it has to be back to where it was a year from now or 2 years from now. Japan has had a prolonged problem with their stock market for 20 years, and so we just have to be able to adapt. We have to have a flexible account, a flexible strategy that keeps us from having these 50% losses in our accounts, because we don't want to have to spend the time and effort to recover from them. That's the key. I don't want you to think, well, if it happens, it'll only happen once and then we can recover. I want you to be proactive about not going through a giant draw down your account over, way over 25%. That's the best way to recover, is to prepare.
Absolutely. And Donald asked about rolling them every month and selling some premium. I think we were talking about UVXY. I think we kind of covered that.
Yeah, I think we did before, but thanks for the question.
I don't see any other questions, so and we're getting close to an hour, so probably a good time to wrap it up. But Evan, really appreciate it. Thanks for everyone who participated in the survey to help improve the presentation. Really appreciate the thoughts that you have to appreciate what the market can really do, and that 22.6% decline. If you think about that in your trades, what would that do if it opened up in a couple of days? down that much, how are you going to react?
Right, and also, how are we going to react if the markets need to close for some period of time? I mean, that's it happened just 14 years ago. There's nothing that says that couldn't happen again. And so those are the two things: a giant move, and that we think we have time, and we really don't have time. But thanks so much for the opportunity, Tom.
Okay, thanks everyone. Thanks, Evan, and we will see you next time.
All right, thanks for listening.